All right. Good morning, everybody. Start of the new week with a short covering rally. The meme stocks are popping. Kind of green. It's not just a new week, it's a new month. Small caps are up the most, likely helped by the meme situation. NASDAQ at 0.5%, S&P closer to 0.25%. There's a little arbitrage play just between those two. Europe and Hong Kong basically flat with the Dow as well. Japan down 0.25%. It's worth keeping your eye on Japan through the day. And a lot of the reports that were coming out over the weekend continued to point to Europe cutting before the US, um, and having more favorable rates. I don't know whose ETF everybody likes to use, but if you're using your ETFs from SMCI, the more of a global ETF, so you can look at markets around the world. There was a really nice report that came out kind of showcasing where we're at year to date and then comparing us against other markets around the world. It still looks like Europe may be the more favorable play. It's hard to argue with that move that we've had in large caps like tech, and then our defensive plays like utilities. ISM manufacturing is going to be the biggest thing on the table today. Very likely weighs on sentiment for the rest of the day. And then tonight, Japan with the 10-year, the BOJ JGB 10-year. You can see that on TradingView, by the way. It's crazy right now. It's well over 1%. We keep watching it for intervention, and it just keeps not happening. But that one's certainly one to be aware of for tonight. I didn't catch everything on Mexico, but it looks like they've elected a lady president, which is awesome. We are seeing some moves in the peso, but I don't know. I need to follow up on that. I don't have all the information yet. And this market is still controlled by NVIDIA. So as long as NVIDIA continues to rally and we continue to see other semiconductor companies hold the line and rally too, then it's hard to see where this market can sell off. But it does put us back in that predicament. We need more than just the Mag 7 to carry the market. And we've seen that massive move in defensive sectors. And there's been a lot of discussion about that. Typically you see those kind of moves in defense, it implies the market is looking for defensive plays, but apparently it's like a backdoor AI play. It's all about energy and utilities for the data centers for AI, which if you remember, we talked about that like 6-8 weeks ago, how every new, AI data center is on hold until they can get energy for it, right? The energy is the big bottleneck for these data centers. And so we're seeing really big moves in AI and anything tangentially connected to AI, which means we're seeing utility moves, which highlights as defense, but it's not a defensive play right now. It's a little tricky. That's why the context matters, right? This is that JGB 10-year that I mentioned, and here's 1%. So as you can see, we've broke out about 1/10%. So still looking at this for intervention, but so far just keeps on going. And the moves in the peso, or against US against the peso. All right, so we got a couple of halfback levels worth keeping an eye on. Right now, what I've got highlighted is the current pullback from the new all-time highs to the low of last week, and now today with the current week. That gives us a halfback of 52.86. We're mainly just looking at, this pullback here. But when we think about that pullback, then we want to measure all of this. After having pulled back, we want to make sure that we don't pull back more than this halfback here. And really, 786 is kind of that line in the sand. If you have a market that's trending, you don't want these pullbacks to go back too far. The books will say 618, but I like 786. We can wick below it. We really don't want to close below it. If we do close below it, it doesn't necessarily mean we're going to go down. It just calls into question the strength of that move, the rally, right? If you think about it just from participation perspective, if this is a good, solid bullish run and people are taking a profit across the highs, which makes perfect sense, we would want to see that investor enthusiasm step in and take the place of those who leave. If this falls back, thank you, Oz. Thank you. Thank you. I did a different, I hit record on a OBS and not on Zoom, so that didn't get the screen shared. Hey, now you guys can see what the heck I'm talking about. We're looking at the ES, talking about this pullback here. We got a 51.65 halfback. Looking at it from on a weekly perspective. This run up from last November with QRA. So if this is just a pullback before continuing on, then we don't want price to get below a 786. We can wick below it. We could even close below it, but we don't want it to close below. It implies a lack of participation, lack of investor enthusiasm. So we can see we're holding above this halfback, and we're also holding above that 786 for now. That's 52.81. If we close below it, it doesn't necessarily mean that we're bearish, just that we likely have stalled out here and we'll start to develop more of a basing pattern or a topping pattern. It can call into question the continuation momentum. But we also right now need to monitor just this pullback. Get the halfback level here, 52.86. This is from the idea if we're only looking at this much, then we want to continue to watch that halfback level. Now, these are weekly candles that we're looking at. So while we have this highlighted, there's another level that we can highlight. It's last week's range, just last week's candle all by itself. So 52.86, 52.72, and 51.68. which is quite a long ways off. We don't want to see that 51.68. All right, we talk about these central pivots mostly on a day-to-day basis, but it's worth highlighting what happened last week. So I'm going to turn on last week's cloud and last week's pivot and turn off the daily one here for a moment. This was last week's central pivot range. Notice there's no channel showing. The channels are turned on. We can see that this week had a channel showing, and this new week that we're in has a channel showing. But this was last week's channel, and it's so narrow that you can't even see the channel bands at all. So on a day-to-day basis, or even on a week-to-week basis, when we talk about having a very narrow channel and you can actually still see a channel, that's not as narrow as it could be. Last week was as narrow as it could be, which is so narrow you can't even see the channel at all. The more narrow the channel, the more likely it is that we could have a breakout or a trend. And that's what we got for last week, was a breakdown, breakout, a trend market, a market that moved, a market that expanded. When the ranges are sideways, wide, big channel sideways, that's when we expect, a sideways market. Now, this channel doesn't make the market move. It doesn't make the market go sideways. This channel is more about trying to understand and anticipate what sort of week we could be in store for, or what sort of day, right? Because this is a weekly, but we look at these on a daily as well. It's not set in stone. You can see this week that I'm highlighting here, we really moved that week, and it was a big, wide range, right? So just because it's wide doesn't mean we can't make big breakout moves and really expand. Just that during that wide week, we're not really expecting the market to make those kind of moves. When it's a narrow week, we expect the market to make those kind of moves. So it just kind of sets us up for our bias, what we're anticipating, what we're expecting. So now we turn everything around. I've got the new week turned on, but I turned off the channel for this week just to be able to highlight today's channel because they're so close together. Today's channel is laying within the range of yesterday's channel. So these are overlapping channels. We are above the pivot point. Right now we have an MDP, that's a missed daily pivot. If we turn on just a regular everyday pivot, you can see we haven't hit it yet. We're also underneath that R1. Now we're barely up this morning, but that does count as a gap. This is a very minor gap. And the focus would be on, are we going to close that gap? We've already closed it a few times. It's not like we jumped up and started running right away. We've dipped back down and hit that value from Globex. So technically it's been closed. But we want to see how we come into the open. There is a little bit of a retracement here that we have to anticipate, and it's this play back to this gap close. Now, if you've been working through any of that order flow material, we've talked about how floors and ceilings, if we get big explosive moves, that there's like a liquidity gap, higher or lower, depending on, which way we went. And that gap in liquidity is why we get back retracements and things like that, how price can go back to the start of the move, because there's really no structure underneath it. but it's supposed to happen within a particular set of time, right? It's not supposed to be so fast. And then this lingering time frame where, 5 days later, we're still looking at it, talking about a liquidity gap that needs to close. It loses its value, right? Because if there's enough time for those floors to get rebuilt, then there's a greater expectation that this liquidity gap no longer exists. It's still the greatest candle on the time frame. I've got it set to like an hour, but if that was the start of the move Friday afternoon, and looking at the order flow over the weekend, that is really where things changed, right? We went from having a two-sided market to just really an all-out blitz in the flows. Then we could have an expectation of coming back and revisiting that 5250. But I wouldn't look at it as a CPI or, a non-farm payrolls kind of gap play where we think it owes us this move back. Instead, I'd look at it as if we break our own Globex low and make it through this pivot point, that would be the next spot where I would anticipate a reaction in the market for a number of reasons. One, it's 5250 round number option level. It's an area of interest. I would already be expecting traders at that level, but also because it was the start of that move. And you're very likely going to see traders' remorse, right? An expectation of traders who got in long or short now having to face the fact that we're back to their starting position. Looking at the average daily range, we're closer to the upper ADR than we are the lower, which makes sense because we're up 0.25%. So with that expectation, we're very likely going to hit the upper ADR before we hit the lower one. We've still got a heavy amount of volume this morning, just like we had last week. We had 99, 94, 109. So we had some pretty good numbers last week, and we're looking at, high numbers again this morning. That's not necessarily a bad thing, but we saw high levels last week on top of market maker moves where they were hedging and there was a lot of volume. Right now, we're just seeing a lot of volume, no hedging yet. The put wall sitting up at 52.15, and Spot Gamma came out with their founder's note on the AM edition right before I started, so I haven't had a chance to read it yet. But I would encourage everybody to read it, even if you're not an options person. Those Spot Gamma reports, it's got enough plain English in it that if you just weed out their options talk, they do put in some just plain English. Are they looking for a bullish market, a bearish market, a sideways market? So you do get some insight on it. They will discuss oftentimes if the put wall was rolled or if the call wall was rolled or both, and whether or not they see that as a bullish behavior or a bullish bias. I've heard from a number of people who say, well, I don't read it. I'm not an options person and it's just too complicated. Don't try to understand all the parts and pieces. Just stick to the pieces that do make sense and try to give it a chance. Some days they're going to be more nerdy and technical than others. So I get it. It might not always help, but if you're a futures trader and you think you don't need to pay attention to options because you're not trading options, you're handicapped. You're completely blind to information that those of us who trade options know that you don't, right? So it's like you're standing in a room with a bunch of your competitors, blind and deaf, and have no idea what's going on around you. And they got all the information and you don't. So something to really consider is at least slowly starting to pick up on options, concepts, and language, even if you don't want to trade them. Got to keep in mind when it comes to trading, right, is always trying to understand why is price moving or why is it not moving. We're back above the 10-day. We're hugging the 3-week. We're above the 20-day, the volatility trigger, 0 gamma, and the put wall. So we've got a lot of structure underneath this. The expectation is that we shouldn't be able to work our way down through those levels without a very deep shock to the market, some kind of outside influence, big news that they didn't see coming, some kind of shock and all that sends us down and breaks those levels. We've got some data points coming in FOMC soon, but not soon enough, right? So I don't know what sort of threat would take us down through these levels, but it would have to be big. I don't think price alone is just going to grind its way down through those levels. Ten-day, 30-minute volume profile with TPO. We got the classic P shape, which we've talked about before. That classic P is considered a bullish profile. But in the textbooks, they always talk about a market that opens near the lows and runs hard really fast and then stalls out and distributes and builds a market that is balanced. It doesn't really talk about in the textbooks a market that fell down and then rallied back up and built that base. Either way, it still says that the P-shaped profile is bullish, and we maybe would have been arguing last week that that didn't look very bullish, but we have now had the TRB, the trend line breakover, and that solid move back up, building this distribution here. So if we just look at that leg, then there's your flag pull, and there's the flag being built. You can call it a bull pennant, a bull flag. Either one of those would be appropriate, but it needs to get out of this channel. The longer this flag stays being developed and the longer this lays out, the more likely it is we're going to roll over, because it would be starting to build more of a cup, an inverse cup. So we don't want it to last too long. Just a nice move up, digest the move, and then leg up again. They call this acceptance of price, right? If you look at the rally we had Friday, we had the same thing. We get it all the time when you get that kind of a move. Can't really see it on, say, a 15-minute chart, but if you were looking at it on order flow, especially, you know, something like a footprint chart or maybe a TPO chart, then you would see on this reversal off of the lows where we pop up, came to an understanding that everybody was comfortable with this new price, popped up again, and then again. It's just what price does, right? If they weren't happy with it, then we would have reversed and came back down and continued the move to the downside. So this is acceptance of price, and then each new consecutive leg up and up and up and up and up. Take that on a bigger scale. That's what we've got going on right now when we're looking at that 30-minute chart. Now that was the TPO in blue where I highlighted that P pattern. If we look at the green, the volume, it's still more of just your D, just a big distribution with the point of control in the upper area. That point of control is right now our resistance 5330 is a cog line, which is just above that. That makes sense. Liquidity resides on the other side of the pivot. So this is a large volume area that we've got to deal with. We're going to be losing a lot of that volume through the day. So as that volume falls off, if we're in that zone now, we're going to be rebuilding it. So we're not really expecting that point of control to move unless we stay underneath that point of control. If we continue to stay underneath it, there is another level back here, right around the 5,300, maybe just underneath 5,300, where we could continue to build out some levels here. If we don't go higher, then we're likely going to cut under here. We can measure this range and start plotting, 50%, 100%. We can also measure the entire thing, cut the half back. So we can develop levels to the downside if we need to. But I wouldn't waste my time doing that until we can actually break below 5,300. It's worth noting that we've spent the greatest amount of trading time at that 5308 area, but we've got the greatest amount of volume down here at that 5302 area, right above that 5,300. It could be from when we came in and got defended and where we've had trading through this area here, and also from last night when we first opened. Either way, there's a discrepancy between a TPO and the point of control right now on the volume profile. We're still not back to our comfort zone on the distance from the 10-week. So far for most of the year, we were riding above this 2% level. So we want to get back up there, but we're still on the fade. We've had a little bit of a wave here. And the distance from each one of these readings is getting smaller and smaller. So we're kind of looking for that turn and that move back up. And distance from the 10-day, same thing. Had a nice curve, but now it's just been a lot of chop. We're continuing to see these lower moves staying underneath this 0.5%, but we are on the swing up. So look to really expand on the daily past 0.5% from the 10-week and get closer to 1% away from the 10-day, not 10-week. We talked about this range on Friday and how Friday morning the range wasn't set in stone. It wouldn't set until Friday afternoon, 4:15. But we had a little bit of a feel for the new week. We were able to see that the week that we're in now was projecting more volatility than the range that we had last week. Now that kind of makes sense. When you have a holiday week, it's going to be less volatility. But last week's range was the same as the previous week's range, right? So now we're going back to like the third week in May. That was a 5-day week. and its 5-day range was as big as last week's 4-day range. So there was volatility priced in last week, and now there's even more volatility. These ranges are derived by the average implied volatility for the week from the options chain. Now, so far, we're pretty much really close to that 5,300, just kind of hugging the line. It's a new month, so we've got the door started this week, day one open range. We can do a 1-day open range, a 3-day open range. I'm not really excited about it when it comes to futures, but I bring it up because, you know, it's door for everything, including equities. So it's worth marking the level out after the day ends, so that you have your day one open range. But so far on the week, this range, you know, we're not testing anything yet. There's a couple of things that we can look at when it comes to these ranges. One is how wide it is, comparing it with last week, but also where's it located? It's below the previous week, just as last week was below the previous week of that one. Now that makes sense. It's not hard to figure out because price rolled over and we pulled back. But we do want to see this, you know, turn around and begin working its way back up. In the last 5 days, utilities still are up more than 2.75%. Energy up more than 2%, while technology is down 1.5%. Consumer discretionary up 1.25%. Financials, you know, up more than a half. So the weakness that we saw last week, that was nothing, right? It was very controlled, very organized. This is still a very broad rally, even though there's just overwhelming amount of attention being focused on those Mag 7. We can see a lot of other sectors participating in this move. We're not necessarily seeing a whole lot of the tech space other than those very key areas. When it comes to tech, it's such a generic phrase, just tech. But if you think about information technology, you've got communications, electronic equipment, uh, hardware, IT services, semiconductor materials, software. It's just too generic to say tech by itself. But all of these is why tech was down 1.5% over the last 5 days. If you were more selective and just pick a particular section in tech, then sure, you can point to some really great gains. So we want to see that broaden out more. We've got a wide base here, a lot of sectors that are participating in this move, but we don't have enough of the tech space. We want to see that really broaden out. It's worth looking at the S&P weighted versus unweighted. Really kind of see that if it wasn't for the Mag 7, you know, we would be down for last month. So semis are up, Bitcoin more Bitcoin, the Mag 7, retail, semiconductors, solar again, which goes towards the small caps, Russell. Emerging markets, so China, the Mag 7 again, another China ETF, biotech, banking, China again through the K-Web. So BABA, Baidu, JD, PDD. There was some good coverage over the weekend on those too. If you think about, it was a year and a half ago when they were calling China uninvestable, and there was a pretty good beatdown in a lot of these names. And now we're starting to turn that corner, right? Maybe trying to come back up, but it's not going to be just a simple little rally and a run back up. I think it's going to take some time. So these are choppy plays, very violent, lots of volatility. BABA this morning is up just barely, but it is up. Baidu, get some dark pool movements on JD, but it does look like it's trying to challenge Thursday's level. Could get a nice reversal play there if we can get above 30 and a half. It's got a lot of work to do and a lot of gaps to fill on the way up. PDD basically flat now at this point. Had a little movement this morning. This one doesn't really fit with its peers though, with BABA being down with such a beat down that BABA has taken. But those China ADRs are up. The meme stocks are up. GME is the leader of the pack, but there's a number of meme stocks out there. I think they've got a meme ETF now. Can't remember what it is. But AMC would be another one of those that fits. This is going to, be called a meme stock rally or a short covering rally, but we really want to see if this spreads out into a lot of different spaces. I've seen names like Kroger get this sort of attention, right? Remember back in the day when we were seeing a lot of meme stock activity, it can broaden out into a lot of places. There's still just short-term plays though, right? So if you are playing in this space, be ready to defend those levels. And probably just want to run, a short interest scan and see what other high short interest names come to mind. There's also a couple of social media monitors. Fidelity's got one, Schwab. I think most of the brokers have one now, where they monitor on social media the names that are getting the most attention. That can probably highlight some other meme stock plays. It's not my space, so I'm not big on it myself. So, if you think about the start of the week, we want a good start of the week based on solid foundation, right? You don't want to start a rally on meme stocks and nat gas. That's just not what you want to, base the start of your week on. I wouldn't want to start any day or any week with that sort of backdrop. We need more than that. Even the K-Web, we just went through a lot of those names. They didn't look all that bullish. They had a little pop, and then they were just kind of dragging their feet. So semiconductors, IWM because of the meme stocks and, the solar, hot stocks are up just barely enough to meet our qualifications. If you look at the Mag 7 or the FANG index, we've got a red to green. I'm on a daily. We had Friday's recovery candle where we bounced on the 20 and we rallied up to close just above the 10. And now in the pre-market, we're gapped up again. We're still inside Friday's levels, but we are gapped up this morning. Watch this as we get closer to the open, see if we can get outside of Friday's levels. If you don't have this little homemade ETF, you honestly don't need it. Don't worry about the weights. It always seems impressive to people who's never seen one of these and they think, oh my gosh, all these weights, I got to get it. You don't need it. If you've got Thinkorswim or TradingView, you could just put the names in with a plus sign and don't even worry about the weights. The chart you get will look very, very similar to the one that we're looking at now. And the difference between them is so negligible that even stressing on getting all these numbers behind it isn't worth it. And the numbers change. You got to keep going in there and changing the weights as their weighting within the sector changes, right? So then it's just this constant chore to worry that your numbers are stacking up correctly and it's got the right weights, and don't even worry about it. Just put in the Mag 7 names, make sure that you are using the right names because they do change. And for that, you can go to the NY FANG index by ICE. Nope, that's not the one we want. And there's your names right there. Right? Broadcom took the place of AMD when they knocked AMD out of this list. Oh, a quarter ago, maybe 2 quarters. So the names do change from time to time. I mean, they're not set in stone. And this is for the FANG index, which isn't always necessarily that quote Mag 7 group. Again, I wouldn't stress on it too much. And the only reason we'd be looking at this at all is because in the pre-market, the NY FANG doesn't move. So we wouldn't be seeing this gap up if we were looking at NY FANG. But if you build your own little homemade ETF, Apple plus Microsoft plus Google, that's how you put it in up here in this symbol. You don't need the weights, and you'll get a chart that moves in the pre-market so you can see this gap up or not. There's also other ones, FNGS. This is just an ETF or an ETN. It also moves in the pre-market, which you can see it much bigger move here than what we were seeing on that weighted one that I was using. So you can just search FNGS. You don't even need to build your own little homemade ETF. The Mag 7 group or the FANGs, they're certainly getting some attention. They are up this morning. There's a ratio that you can use. Yeah, we want the other one. IWF, IWD. For a ratio chart, the first name on the ratio is what is leading when the chart is moving up. And the second name on the list, that's what's leading if the chart is going down. And this is small caps, growth versus value, rather than using something like the large caps and then doing growth versus value. There's also ETFs of just growth and value, and you could just do the same thing. Those ETFs alone will choose what markets it wants to put in there for growth and value. But in the pre-market, that growth value one, I don't really like the lack of movement on that one. So in the pre-market, I like to use this. Well, all day I like to use it, but it works in the pre-market too. This is small caps, but you can use it just for a perspective on the day, growth versus value. Generally in the pre-market, if we've got the Mag 7 up, if we're looking for a bullish day because of the Mag 7 being up, I like to see this up too. And right now it's not. It's showing where we were Friday. So that's one I would be keeping an eye on, especially with the meme stocks. And, you know, we are seeing small caps moving, and this is small caps growth versus value. I would expect it to be up. I'm surprised that it's not. At 8:30, we're going to get data. Or excuse me, 10. So this ISM manufacturing kind of a big deal. But we are seeing moves here, like it's looking for an 8:30 print. We want to make sure we're not getting a little out of control on the dollar and the 10-year. So keep your eye on those two through the morning. It's good to see that 10-year breaking down below 4.5, but we want to continue to see it move lower, not just for today, but through the week and through the start of this new month. We need that 10-year to just nice, subtle moves to the downside, get below, you know, 0.1% level by level, 4.5, 4.4, 4.3, just not really fast, right? We don't want that kind of shock and awe in the market. Keep the dollar under that 105 level, then get through that 104.5 and get below 104. Just use the 50-cent levels nice and easy as well with this one. We've got Friday's range, which we're still holding inside of. We're back below the half back, so let's just keep that, get through our own Globex low, and then get down to yesterday's low, right? Just level by level. We don't want these sudden sharp moves in this either. Got Bitcoin up. So looking at the Bitcoin space, Riot, Mara, Hut, Hive, Coin, MSTR. Could expect to get a play in this space as well. Yeah, they're all looking pretty good so far. They're looking better than the China ADRs anyways, say it that way. And it is the first day of the month, right? The first trading day of the month. So That means once we get a daily candle here, you can mark out the daily candles low and high at the end of the day today. That'll be your day one open range. You've got that, and then you can do a 3-day. So it would be today's daily candle after the close, and then tomorrow's and Wednesday's. And after Wednesday's close, you'd mark those 3 days combined, the highest point out of those 3 days and the lowest point out of those 3 days. Right? If, like if this day was Monday, Tuesday, Wednesday, end of the day, mark the low, mark the high. It's a very old school open range concept. And yet on equities, I have found just the insight of that has a lot of value. So it's worth kind of digging into a little bit if you're not using it. One thing about these Bitcoin plays, we'll just use Mara here since we're on it. This is the range. Don't worry about the extensions. And what we've got to be concerned about here is this halfback level. So, it's trying to rally up off this low, but it's got a 50% mark that it has to deal with, that 2084 on Mara. If we can get above that, then we've still got all this activity showing that they were fighting against this, right? That there's just a lot of sellers up here. We don't know that they're done yet. We've only tested them a few times. So watch the dome. If you're trying to play this move, look for a lot of trading activity up here that's defending these levels. Because if there's still a lot of sellers up here, that wall of sellers is going to shut this down. It's a bit sloppy on the daily for coin. Take the whole week. This really big candle from 2 weeks ago. That's the range that I would focus on. Half back 221. Kind of hold that level. We're fine. We're at 232. So we're well above that. You can also just take last week all by itself. 234. That's your line in the sand. Got to get through that. Now we popped up through this range. Let's drag this back here for a minute. We got through this level and it just keeps getting sold off, right? Even this large drive, it got sold off. We got right back down below that level. So we're back again above this level. Got the gap up on a weekly. But this is the zone. And there's still just a lot of fight here to the upside. We don't know if these sellers are done, but 240 is certainly a level I would be watching. If we can get through 234, then 240 is the next one. They weren't able to keep it last time. Should be a pretty laid back week. See how it all unfolds. Got a good start with a broad base, a lot of different things moving in the right direction. Let's just see it broaden out into the other tech areas. Everybody be careful, be safe, watch the clock. I'll see y'all tomorrow.